Hello everyone, welcome to the newsletter for the 21st of February. So we've got a few milestones we've hit of late. Bitcoin has surpassed 55,000, which is just quite frankly remarkable. It's now a $1 trillion asset class. So we're now talking about serious money. We can actually start looking at these large investment firms that have to take it seriously now. You really can't ignore Bitcoin as an asset. And, honestly, this is truly remarkable. It's I think everyone's probably surprised at how quickly we went from all-time high to here. But when you actually look at the macro backdrop and just the amount of momentum, and when we've got senators putting laser eyes in their profile pictures, Elon Musk's Twitter profile is just currently a Bitcoin logo. Right, we're seeing all of this stuff happening. I mean, it feels like froth. It feels like what you would otherwise think a top looks like. But in many regards, when you actually delve into what's going on, it kind of looks very, very real. It looks like it could very well be sustainable. We're getting 1-2% dips and they're just getting bought up. I mean, it is truly remarkable. And I think what we need to really do is look at everything in a very, very big picture, because exact same feeling that we're seeing with Bitcoin right now, where it's like, man, all the models are just exploding. This same feeling is across all markets right now. So, I'm an avid listener of the Macro Voices podcast and also for Real Vision. And we're just seeing this tone in some of the smartest guys in the room saying, you know what, this is actually the new normal. What we are seeing is the inevitability of currency debasement and what it actually looks like in asset prices. So it really is the whole world and people in markets trying to reevaluate and reconstruct their framework to what is very quickly looking like a new reality. So we're going to touch on a few different things today. I think there's a couple of key points I just want to touch on, and then we'll run into an on-chain update at the end. So let's kick into it. So what we'll talk about very quickly is some of the macro trends that I think are in play and a little bit about my thoughts. It is a very complex problem, obviously, and we're seeing a rotation from a deflation review to an inflation review. And I just want to talk about some of the mechanics as I understand them as to what's really driving that. We'll have a very quick discussion about the dynamics of Ethereum and Binance Smart Chain and some of the smart contract competitors that's going on. This is a very, very contentious topic. I personally am trying to come at this from to be honest, I don't really have a dog in the fight. I think it's just interesting watching how these different chains are competing and how the community is reacting to it. And I think what I really want to convey across is what we're seeing going on with Binance. It is really, really interesting because I don't think anyone can argue that it is taking a huge bite right now. Whether it's sustainable or not, we don't know, but it's taking a bite out of Ethereum's market share right now. And the question is it going to sustain? And really, I think we have to look at the crowd that's coming in, and they just don't care as much about principles, values, and decentralization. Now, does that mean that through the bear market it's going to outperform? Well, probably not. But we have to think about this framework and what are the actual constraints holding back Ethereum, and what are the real risks, right? If we're investors in this thing, we need to understand what the real risks are for Ethereum as a platform, and potentially what opportunities look like outside that, right? And we'll talk into that in more detail. It may end up not being such a quick discussion. You know how I like to rant about these things. And then we'll do an on-chain update for the week, because I think that's just really, really important to get a bit of a view. There's certainly, that's going to really support what we're seeing in the macro side of things. So let's carry on with our macro side. Now, I've forgotten to do my podcast recommendations, so I'm putting them up the front so I don't remember. So I remember every time. 2 podcast recommendations this week. The first one is on Hidden Forces. There's 2 parts with Radigan Carter. This was some of the most, particularly part 2, the second 2 hours, which Dimitri released as part, just because he felt people needed to hear it. So it came outside the overtime, which he normally does as a paid subscription. Radigan is a seriously deep thinker. He's really considered some very deep philosophical concepts, particularly when it comes to things like the geopolitical tensions between the US and China, and how Bitcoin is a reflection of the unrest in society at the moment. I really couldn't recommend a podcast higher than this. I really think that it is a key thing to try and get your head around and grasp what on earth is going on. And I think Radigan's got a really, really sensible approach, a very human perspective, and I think that is markedly undervalued. I really do think that it's a really really important podcast just to get your head around some of the darker sides of what decentralization actually means and what the notion of opting out really means. So I think it's a really important one to listen to, just to get the big picture understanding. It's yeah, I couldn't recommend this one strongly enough. And for anyone who hasn't seen it, strongly recommend listening to Michael Saylor and Ross Stevens. So this was part of the MicroStrategy Bitcoin conference. And really, they talk about the challenges of capital allocation as a CEO, right? What are the risks that they're currently facing with how they deploy capital and maintain shareholder value and company value? These guys have to deal with this serious problem of money debasement and having large treasuries and cash flow producing businesses. What do you do with it? And they talk about the pipeline of people and institutions who are getting involved in this asset, in Bitcoin particularly, and just what that pipeline really looks like. So I think it's really important to get a bit of a view on this, because it just gives you so much insight into, I think, what the trend is that we're going to see that's going to support, I think, a continually higher price. It really is it's a trend that is very real, and as much as many of the people who don't want Bitcoin to succeed or believe that it's fundamentally flawed, as much as they want to throw dirt at it, unfortunately, I do think that they're very, very wrong, and the data and the trend is really showing that. So, macroeconomic overview. Let's go through the really big picture stuff. So, almost all macroeconomists, if you were to go back 6 months, were sitting in the deflationary camp, right? So you've got your regular camp of these high-level macroeconomists who are thinking about the future and what's the most probable outcome. Most of them were deflationists, and essentially they're looking at the three simply ginormous deflationary forces, and that's technology, which just literally makes human beings more efficient. We get more done cheaper, so that's going to reduce pricing. Technology is exponentially deflationary. We're looking at demographics, right? So there's going to be plenty more Harolds floating around where you just spend less when you're 65, 70, 80 and going into retirement. And we have the largest generation with the largest wealth pool going from net spenders to net savers, and moving into retirement. So the baby boomers retire, and then coupled with that, we've got the world's largest debt. And the only way you can really deal with the amount of debt we have right now is to make it smaller via inflation. And the number one driver of inflation historically, so let's exclude modern, very modern, right, the last couple of decades, the normal drive for inflation, sorry about that, the normal drive for inflation is essentially growing population, growing productivity, more people coming into the market, actually generating value, right? Generating new jobs, generating new capital flows, new GDP. We don't have an increasing population at the moment, particularly in the West. In Asia, they're about a decade behind us. Japan is about a decade ahead of us. We've kind of seen where this is going, and this demographic shift. There's just not as many people being born at the moment. We have a population decline, and that's really going to struggle. We've got massive debt, which has essentially been borrowed from the future. So ultimately, there is a lot of deflation that wants to happen. Now, the problem is that we have an inflationary system, and that debt must have growth. We have a system that requires growth to exist because it's debt fueled. So if the debt isn't being inflated away, eventually it's going to come and bite, and the system simply cannot deal with it. Yep. So I think this is the challenge that central banks have, is that they have essentially created a system that has been unable to flush out all of the dead wood. The forest fire has been unable to occur to actually clear out the bad debt, the zombie companies, the bad choices, so on and so forth. And ultimately, the only way that they can now try to generate inflation is by printing money. So what they are literally doing is propping up the system, because if it collapses, it's an untenable scenario. No central banker and no government wants to have a falling system, and even 20% declines in asset prices right now have just otherworldly level direct implications on stability. So they're in a rock and a hard place, and it's a really, really hard place. So the difference we have with the inflationary forces right now is they're doing direct stimulus. So in 2008, it was essentially propping up corporations who then just put into a QE, buying bonds, and that money just went into assets. Now they're putting money in the hands of people who will spend it. So we've got direct stimulus that is, by all accounts, Janet Yellen recently was saying that it's not a risk of going too small. Sorry, the bigger risk is going too small on stimulus, not going too big. So they have, and average inflation targeting, all of these things. The central banks are hell bent on printing money. This is the direction that it's going to go. We're already seeing asset price inflation. People are, when you normalize a lot of stocks and stocks and commodities and things, when you normalize it to the amount of money printed, they actually look pretty cheap, which is insane. But this is the world that we're in. So they're a mirror. They are offsetting or direct or showing how much the currency is being debased, and Bitcoin is being the most free market that exists is heading in that path. We're seeing things like supply constraints. So in some commodity markets, certainly in the oil market, there's supply constraints, and we're also seeing in semiconductors and things like that there are supply constraints that are driving prices up. We're seeing in Texas at the moment there's misallocation of capital into energy resources, and now they're dealing with some fairly serious blackouts. And there's going to be supply constraints that's going to drive up prices for things. Coupled with that, if you get any of these tensions start to blow out, we're going to get more trade disruptions and all that, and that just leads to price inflation. And there's actually interesting. There's a whole layer of China that's coming into this, who they actually also may need to start increasing the price for their goods, which imports then go up, and you just get this supply constraint, or because there is China needs to pay back their debts. They're going to start raking in more money, and that becomes a larger part of their GDP to start clearing some of this debt, and it's just very, very messy. But it is likely that we're going to see prices rise, and it will probably be in select areas. In some areas, it definitely won't. So there will come a point when people start to recognize that there is in fact inflation, and inflation is very, very psychological. In that when you start seeing it happen, people start behaving differently, and then that actually drives inflation higher. So it could be a bit erratic, where we get these spikes in inflation that goes up to 4 or 5% and then pulls back down. But unfortunately, we still have things like QE that's going to be in operation because markets can't deal without it. The Treasury is getting ready to spend almost 1.6 trillion, I think last I heard, direct into the economy. They're going to start doing things like infrastructure spends, which is going to be employing a load of people to try and fight the recession, and that's going to put more people spending into the economy. And there's just all of these things going on. Simultaneously, we're seeing yields on the 10-year and the 5-year start to creep upwards. There is going to come a point when, the pig on the left-hand side here, which is just so much debt, you can't pay that back. I heard this morning on a Macro Voices podcast that if interest rates go up by 0.5%, right, which is like small on a relative scale, the US expenditure on interest is equivalent to the entire Navy. If it goes up 0.3%, it's equivalent to the entire Marine Corps. If you have it go up 0.8%, which is recently done, your interest bill is now the Navy and the Marines combined. I mean, that's the scale of money we're talking about for very, very small interest rates. So what is the most likely scenario here is interest rates will try to creep northwards, and central banks are most likely to implement yield curve control, because essentially they have here's their choice. It sucks. It's either they print money to buy the bonds to keep yields down, which is what yield curve control is, because when you buy bonds, you reduce the yield, right? Demand for bonds reduces the yield, and when people are selling bonds, yield goes up. So they're going to print money to either buy bonds, which will decimate the currency, which is probably the most likely outcome, or they allow interest rates to rise naturally until they hit some kind of pain point and the market has a dummy spit, and then they probably have to go to yield curve control anyway. So it's a really, really bad position. But a lot of these big macro guys are transitioning from deflationists into inflationists. So this is the direction that we're likely heading. So let's quickly touch on Ethereum versus Binance. Now, what I'm viewing this as is basically a battle of ideals, principles, and profit maximalization. So people who come into the space today are not going to have the ideals of decentralization. They're not going to really care that much about DeFi and how it's going to change the world, because they want to make money. They just want to make fiat currency. They just want profit. That's all they care about. Now, in the long run, yes, decentralization is extremely important. But it's also extremely hard to build, right? The technology takes time. You need very, very talented engineers to build it out. And ultimately, Ethereum's consensus team is a handful of people. It's a very very small team because just there's so few consensus engineers that can build this stuff. So it's going to take a long time to build out technology to help scale decentralized infrastructure. It's just a fact of the matter. So ultimately, Ethereum is essentially what I think is at the capacity. I really don't think it can support any more transactions. We saw this spike in DeFi summer, which in a way was it was a bit of a miniature bubble, but we really did see gas fees spike, and we're essentially rallying back up to that same level, right? So it's starting to get to the point where the chain is congested enough that it's squeezing most people out. I think you all know how the fees are just. I mean, ultimately, it is unusable, and no noob is going to step in with their $200 and spend $30 on transaction fees. They're just not, right? This is just a hard reality. And Binance is, they're stepping in and doing exactly what Binance does, which is finding a gap in the market, copying and pasting what works, making it centralized, and making it super cheap. And people are flooding to it, right? So we're even seeing, this is search history. Amazing that we've got Ethereum and Binance. This is not a huge delta, right? So we may not like it, but this is the direction that the market is currently trending. The plebs really don't care. They want to make money. This is just the reality, and this is what the frothy side of this market looks like. This is why the ICO phase did what it did. And if we look at the daily transactions, Ethereum is 1.3 million transactions per day. You can see that we're pretty much up at the same peak level. It probably can't rise much higher than that because it just simply, people will stop paying the fees. It is at capacity, and this really highlights how important scalability is for Ethereum to start really getting going. And Binance has 3.2 million transactions per day. Now, how much of this is fake? I would say probably a lot of it. We just don't know. But ultimately, this comes down to principles versus profit. Because if you've seen the BNB chart, far out, right? We all missed that one. Principles versus profit, right? What do? How do you actually think about this reality? The way I'm thinking about it, if we look at my genuine fear for Ethereum, and as much as I'm critical of the project, I really do want it to succeed. Ultimately I want Ethereum to succeed because it is the best smart contract in terms of principles, in terms of network effects and the developer side of things. It's all there. You can see that DeFi is transformational. You can see it, right? You can see where this market is going. It is transformational in the best way possible. But scaling is just going to be a long way off. Now, you'll see they've got lots of L2 solutions, loopring, and optimistic roll-ups and all of these things. And that's great. That is good. But the problem is, for every single coin or token on Ethereum, in every single DEX, that's a new transaction to arbitrage the price every time the price changes. When there is profit on the table, there will be transactions to fill that gap. And it's exactly the same as mining. Miners will increase their hash until the point where it matches the block reward. Someone will keep bidding until that point gets hit. Now, the more assets that are on Ethereum, the more DEXs that are on Ethereum, all of these different elements create a new arbitrage transaction, and bots are just running this thing. Yeah. So the challenge is that I don't believe that any of these roll-up solutions, they may solve the problem for a project, for synthetics staking, for example, or they may solve the problem for loop ring trading. But how do you actually onboard users to those L2s? How do you actually get people from L1 to L2 if they don't want to touch L1 in the first place because it's too expensive? Will any of those actually solve the real problem, which is that you have DEXs and tokens with price? I just don't think so. So, sorry, they may do, but it's not soon, in my opinion. Now, I could be very wrong with that. I will be fair. I don't follow the scaling side of things too closely, but as far as I'm aware, there's no incentive for exchanges to want to onboard people to L2 DEXs because it's literally onboarding them to their competition. They would rather gas fees be very high because then people are not only on their platform and stuck there, but can trade between ETH and DOT and whatever else is out there, right? The ETH killers on whatever the hype news is. That's what the exchanges want. They don't want to help Ethereum out, right? They love these high gas fees because it pushes customers back to them. It's literally their competition is currently hamstrung. So, we're going to see things like Binance, Polkadot, Cardano, whatever Ethereum killer you want to put in the ring. they're going to attract noobs, devs, and eventually dApps, right? We've already seen compound finance is starting to build their own chain to interconnect between multiple things. We're seeing wrapped Bitcoin starting to appear in all these other chains. We're seeing some of these dApps bridging across and sitting on multiple things. This is what I have been saying about the thin protocol thesis. And this is essentially that the dApp layer is more likely to accrue value than the smart contract chain, because ultimately the dApp can move between whatever chain is solving the problem the best, right? If Solana has faster transactions and enables a dApp to make more money more quickly, then of course these governance dApps are going to want to move over there and build a token there. And when I look at the chart of Ethereum versus Bitcoin, I'm not going to say I'm excited by it. You know, like, it is underperforming the slow, boring, poor tech, right? All the critiques you want to level at Bitcoin, Ethereum is underperforming it, and you know this is just a hard reality. So you know it is a principles versus profit side. It's not an easy thing to kind of get your head around and process it all. But this is the trend we're seeing, and it shows that we're getting into the later stage of the cycle, because dumb money is definitely here coming in. They don't care about decentralization; they care about making money. So this is kind of this is the world that we're in. This is what we have to trade. This is the market that's in front of us. In the long run, maybe it will perform better. Maybe scaling is far closer than I believe. And to be honest, I hope it is, because I really do want Ethereum to succeed. But right now, I'm concerned that there is so much competition, and I'm not convinced that there is a moat around these network effects, because the gas is simply going to push people out. And it doesn't matter how principled someone wants to be, right? A lot of the Ethereum maximalists will defend this thing to the end, which is great. That's what you want to see. That's the religious side of things. But they're also struggling to deal with the fact that scaling is not close. I just don't think it's close. 2.0 is not close. There's a reason they transitioned to a roll-up centric roadmap, and that's because 2.0 is some way away. You know, there's a reason you don't hear much about 2.0, because it's a long way away. You know, EIP 1559 is still a long way away, and there's now threats of minor contention that they don't want to implement it. So this is what Lynn Olden talks about with the risk. There is so much risk between Ethereum now and Ethereum in 5 years, and remaining relevant, maintaining market share, maintaining network effects, getting through the technical hurdles, getting through the mining hurdles, getting through all of this stuff that just Bitcoin doesn't have to give a shit about, right? That's why Bitcoin is outperforming, because it is finished product. You know exactly what you're buying. Ethereum, long way to go until you know what you're buying. So you know, this is kind of my overall view. I want it to succeed, but I certainly see some roadblocks and some concerns. So let's jump into part 3 of this overview. We'll look at the on-chain side of things. So we'll look at I've got 2 dashboards set up, and then I'll also go back to my tried and trusted check on chain to kind of get a bit of an idea about where we are in cycles. So I've been watching what are the old hands doing, essentially, because the way I look at it, we've got institutions coming in, buying in size. We have old money who is basically selling out to retire. They don't like the narrative. They do like the narrative. 50,000 is a pretty attractive price. We bought it at $600 or 3,000, whatever it is. People are starting to essentially liquidate into that strength. Now, that doesn't necessarily mean, right? It's all supply and demand, and we have unprecedented demand. Simultaneously, we have, you know, some of those large holders are going to start cashing out. So there's going to be a tipping point at some stage. So what we're seeing here, in particular, probably this guy here, if we look at, this is the number of addresses with 1,000 BTC. What's been very interesting is since the Elon candle, we've actually had some reduction in that. So let's just look here. Number of addresses, 2,400. 2486, what's that? Sorry, 2486, 2435. So 50 wallets, right? So 50 wallets, 50,000 BTC maybe have moved. Maybe they've just lightened their position and they're just slightly less than 5,000. This is addresses with 100, so they would otherwise fall down to this category, seeing a little bit of a liquidation here too. So what this is telling me is we are seeing some of these entities start releasing coins into the market. So, you know, 50,000 is a pretty exciting thing. $1 trillion asset class, it's a milestone. It kind of makes sense. We're going to get a little bit of an off-sell. When we look at balances and accumulation addresses, so these are wallets that have the heuristic of being a long-term holder. where they're actually withdrawing from exchanges. We're not seeing that major sell-off, right? So, I think that what this is saying is that there's probably being a transfer from the very big guys to some of the smaller. There's still people stacking sats, right? That could be what this is telling us. Our exchange balances, right? We're kind of sideways. We're starting that downtick again. So this is promising. This is good to see. It's telling us that the trend is still good. Miners, continuing to build up their wallet balance, and again, they're relatively small accumulators, but they're not dumping. If we look at things like our time metrics, so our time metrics is how old coins are, and obviously the older they are, the more profit they're going to be in. So there's a link between profit and coin age. So if we look at the coin days destroyed, so how old are the coins that are currently on the move? Let's look at it on a 1 year timeline. We've got a bit of an uptick, so this is saying that there is some older coins coming back to life. We're not talking about the same magnitude as we had back here in in the rally up to 40,000, but we're certainly seeing a slight uptick. So I think what this is scaling out, right? These are whales that who bought very, very cheap, scaling out essentially. You can see the same thing in entity adjusted dormancy, which is more or less a very similar metric. We're basically seeing this slow scaling out of profits. Dormancy flow is starting to kick back up. So this is kind of the MVRV version of dormancy, which actually, let's just have a look at that on the big picture so we can kind of see where we are in a cyclical sense. So you can see here, this is more or less defining we're moving. I mean, pretty impressive that we're only just tagging this level here. And maybe that's actually because 2019 was actually a big flush out, right? This was a nice, healthy consolidation prior to this rally higher. But you can see that we tend to exist above this for most of the bull market, and we're really only just getting back above it. So, I mean, this is pretty cool. So this could very well tell us that we still have some ways to go, right? So, and then if we jump back to, in fact, we might jump back to this guy here. So this is my old hands, right? This is specifically looking at a lot of the time-based metrics, the old hand metrics. We looked at our coin days destroyed. You can see that our binary coin days destroyed is actually ticking back up. Let's zoom into 6 months. You can see we still have a little bit of liquidation going on. So when it's green, it essentially means that the coin days destroyed is greater than the longer-term average. So this is really telling us that there is scaling out going on. We're seeing our short-term SOPR and our long-term SOPR still ticking up. So I think across the board, there is profit taking up here at 50,000. It kind of makes sense. It's a bit of a psychological milestone. Maybe we get a bit of longer-term consolidation up here. Maybe that's what that's telling us. We've got more supply that's starting to come into the market. I think none of us would be surprised if we got a bit of a pullback. I think we all probably see it as being a little bit overdue. But again, when you look at the macro backdrop, would you rather hold dollars? It's a really hard problem. So I don't blame you for being in the same place as me, which is do you take profits? Do you not? Not sure. Certainly, we're seeing scaling out by the smart money, right? So we're not seeing dumping. We're seeing scaling out. We're not seeing mass movement of coins. We're just seeing the occasional wallets starting to offload a few coins. So, that's the general view. Overall, the exchange balances are still going down, which is, it continues to be one of those powerful metrics that's telling us what's going on aggregate. I think the institutional adoption is still going strong. So if your time horizon remains years, which I think it probably should, really, I think it remains accumulation territory for the long game. Yes, we might start getting some volatility soon, but simultaneously, the more institutions start to step into this market, the more volatility will get squeezed out, right? Because it's just larger buy on the way up, larger selling and larger buying in size, and they generally control the markets a lot more. So you're going to get you've seen that this particular rally has been quite technical. We're getting a lot less major sell-off corrections. It really is. It's kind of been up only. So that's the general view. I think they're scaling out. We've definitely got some interesting dynamics going on with Ethereum and its competitors. It's definitely a trend to watch. It's a trend to have open eyes in. If you are really looking to understand what kind of risks Ethereum is in, very likely understanding the scaling technology and how far progressed that all is probably a good starting point. I don't know whether the composability gets broken. I think it does to a large extent because essentially L2 is just another chain. It's a second chain. So you would need multiple dApps to move to that second chain, which that's going to take time as well. So that is a real challenge. We're going to see how this centralized Binance chain, Binance Smart Chain, compares in just market pricing. I mean, BNB has just been on an absolute tear. We'll see how Polkadot and Cardano and any of these other, in inverted commas, Ethereum killers perform. Ultimately, I'm not particularly bullish on any of them long term, but short-term trades, there's most definitely opportunities here. We're definitely seeing a bit of a cool off in DeFi as basically that cool off in DeFi is the market recognizing there's going to be some time until those apps are able to accrue the same kind of value that they were a month ago. So that's more or less what's going on. And the macro backdrop is it's a bit nerve-wracking, but I think it's a bit of a paradigm shift where essentially the denominator in all of these things, fiat currency, is almost guaranteed to be printed into oblivion. And the question is, what would you rather own, dollars or a scarce asset? So this is the crazy world we're in. Definitely listen to those podcasts that I put up. I think it gives you a really good perspective on what's going on, particularly Radigan. I think he's got an excellent view on things. You'll absorb a lot from it. And as always, if you need anything, grab me in the chat room. As of next week, I'm essentially full-time in this industry. So I'm really looking forward to producing more and more of this content. And you'll have a whole lot more access to me because I won't be staring at engineering problems anymore. I'll be staring at Bitcoin charts. So make sure you grab me in the chat room if you've got any questions because I've got more time now. So happy days, and thanks all for listening in. Cheers.